Hey, what's up everyone, and welcome to the School of Personal Finance. So I woke up in the middle of the night, I couldn't fall back to sleep, and I made the mistake of going down the velocity banking rabbit hole. And I did this once before years ago, and I've made a few videos about velocity banking. One of them about how it doesn't work because I kept seeing the same example used over and over in these gimmicky videos. So I just went through that example showing that it really does not work. All right, but then I made another video talking about how I grew my net worth using a HELOC. And everybody called me a hypocrite and said that I do use velocity banking. So in this video, I want to show you a clip from one of the videos that I watched last night and kind of call it out. You know, there's so many people, it's like their religion, where they believe that this velocity banking method, that they could pay off hundreds of thousands of dollars in debt in just a few short years by using this velocity banking method, where I'm going to make the argument that you could do exactly the same by just using the excess cash flow and paying off the debts directly instead of using these personal lines of credit or credit cards or HELOCs. So yes, I did use a HELOC to purchase rental properties years ago when the rates were very low, and I borrowed the money to leverage and buy real estate. And I'm still a fan of that. Unfortunately, the interest rates are much different now. The environment has totally changed, and you cannot do that anymore where it is profitable with these record high real estate prices and these very high interest rates on home equity lines of credit. But I did want to go through this example just to show that you don't need to hire these people to help walk you through this complex matrix of velocity banking to pay off your debt faster. If this is your first time here, my name is Rich McCormick. I'm a certified financial planner. I've been a financial advisor for over 20 years. This channel is all about growing your wealth, getting out of debt, investing in the market, saving for retirement, protecting your family. If you're interested in all these topics, please go ahead and subscribe to the channel. Also check out schoolofpersonalfinance.com, everything that I have going on over there. I think we would all agree that a 0% interest rate is better than paying 20% interest rate, right? If you owe $10,000 and you're paying 0%, that means you owe no interest. If you're paying 20%, that means that you're gonna owe $2,000 worth of interest for the year, right? So by transferring it over, you are saving $2,000 worth of interest. You still owe the $10,000 debt. We haven't solved that problem, right? All you're doing is you are saving on the interest costs by moving it from 20% to 0%. And I think we would all agree that that is a smart move. It makes sense to do that if you have the opportunity. So now with a personal line of credit or a credit card, they typically charge interest on the average daily balance. So if that's the case, then it makes sense to try to reduce that average daily balance to the best that you can, right? So with velocity banking, what people talk about is parking your paycheck, taking your paycheck and dumping it into your personal line of credit or a home equity line of credit and leaving it there for as long as you can until you need to use it to pay bills. And this makes sense because by doing that, you are reducing your average daily balance, which is going to reduce the interest charges. But I would add on to that it never makes sense to take debt that you owe at a lower rate and move it over to a higher rate just to consolidate it. To me, all you're doing is you're increasing the interest charge on the amount of money that you borrowed. And then one more thing, because it relates directly to this clip that we're about to watch. When you take your paycheck and you dump it into a line of credit, that satisfies the payment for the month. So you'll hear these people talking about how you've just increased your cash flow because now you've eliminated the payment on that line of credit because you dumped your paycheck into it. So this is true, but at the end of the day, it works out to be exactly the same. If you include that payment as part of your expenses, all right, then it's still going into that line of credit. It's still reducing the balance because you have to make a payment to the line of credit. Where if you just dump your paycheck into it, then yes, you don't have this payment anymore. Now you pay out all of your expenses. So you don't have to pay out that expense to the line of credit because you already put the money in there. But the balance on the line of credit, it ends up in the same place either way that you do it, right? You're still putting your money in that line of credit. If you want to say it's an expense and it's as a payment in the beginning, or if you want to say that you're just dumping your income in there and now you don't have to shell it back out because you don't have that expense anymore, either way, that money is in the line of credit, reducing the balance. So the balance is the same at the end. You're not creating cash flow out of thin air, and I'm going to show you that right now. All right, so I'm just going to show a couple of minutes of this, and I do want to say I really do like this presenter here. I think that she does a very great job, and she is convincing, and I don't think she's trying to harm anybody. All right, so velocity banking, it does help you. If you were to watch these, it would motivate you to get very organized and to lay out all of your debt and to really want to pay it off, to motivate you. So for those reasons, I think that this is great. My point is, you just don't need to go through all of this in order to pay off the debt. It doesn't have to be this complicated, and you don't need to hire somebody like this to show you how to do it. You could figure this out for yourself, all right? You go through the debt snowball, you come to the same place. You might even be better off. It all depends on the interest rates on the debts that you have. But we're going to watch this only for a little bit over a minute, and I'll comment as we kind of go through. I'll stop it as we go through as well.
But is velocity banking a scam? Let's see. So we're going to start with a person that has a $6,000 income. The expenses are $4,740 with a cash flow of $1,260. They have a Bank of America line of credit, a Capital One credit card, car, rent, utilities, food, gas, car insurance subscription like we all have, right? With this strategy, we're going to use the Bank of America line of credit. So the $8,500 is the balance. The current payment every month is $215. So with velocity banking, every time you make an income transfer into a line of credit, you have satisfied this payment. So this payment no longer applies. That is now cash flow.
Just to explain this real quick, especially if you're not familiar with velocity banking, right? So we're saying in this example, the individual has an income of $6,000. Their monthly expenses is $4,740. Now that includes all of these payments that they show down here, all right? So rent, utilities, food, gas, and it includes the payments on this Bank of America line of credit that they currently owe $8,500 on. So that payment is the $215, right? The Capital One credit card, $320, the car, $620 payment. So that is all of their expenses, all right? So what she's about to say is that her current expenses are that $4,740. But now she doesn't owe that $215 anymore on that Bank of America line of credit because she's dumping her paycheck in there. So that eliminates the payment. So right out of the gate, she's cash flow positive from doing this $215. But what I'm going to show you is that's just absolutely false.
Expenses that were $4,740 are now $4,525 because we subtracted the $215, okay? So when you take the $8,500 balance and you just bring the income in, paycheck parking is what it's called, you'll have a balance of $2,500. With a line of credit, the bank figures the interest on the average daily balance. So today it may be $8,500. Tomorrow it may be $2,500, depending on when we pay in the income. As these expenses at $4,525 come back out through the month, the balance will slowly raise back up. Then at the end of the billing cycle, they will charge the interest based on whatever this average daily balance was. So I did an average daily balance of my own by taking the high and the low, averaging it out, and then charging a 20% interest on this line of credit. So that interest charge for this month would be $92, approximately.
So I'm going to stop it there. So that was good. That was a good explanation of that. And she's right. I mean, that's how it's calculated. And $92, that's fine as far as the interest expense. So she is now saying that this $7,117, that is going to be the amount that's left in that line of credit after she went through this for the month, right? So she dumped her income in there, then she went ahead and she paid her expenses out of it, right? And now she paid the interest, the $92, and now she's back to this $7,117 after the first month of doing this. So now let's compare that to if we just pay normally and we don't use this velocity banking, all right? So walking in, they owe $8,500 on this line of credit, right? They have their income, they have their expenses, and their positive cash flow. So they're just going to pay their bills as normal. The cash flow of $1,260, they're going to put towards that home equity line of credit. So $8,500 minus $1,260, that would be $7,240 that they owe on this line of credit. But now remember, this $215 that's part of their expenses, that is a payment towards this line of credit. So that's going to reduce the balance of this line of credit as well. So they will owe $7,025 on that line of credit. And we have to add in that $92 of interest, which brings us to the exact same place of $7,117. There is absolutely no difference between the velocity banking or just paying your bills out of your cash flow here. All right. The only thing that could move the needle would be the interest rates, right? So if the interest that they are saving by dumping their paycheck into that personal line of credit, that reduces the balance for however many days it is, that is really the only savings that I could see here. And honestly, it's just not going to be a lot because they have to pay their bills throughout the month. So you dump your paycheck in, a lot of bills are due the first of the month, the first few days of the month, you're sending it right back out again. And it depends on when you get paid. Not everybody gets paid the first of the month, right? You might get paid the 1st and the 15th of the month. So all of this, and there's very, very little interest savings, if any, at the end of the day. All right, well, I hope that explanation made sense for you and it did debunk the savings that she's claiming that you get after that first month. And then she goes through it every single month after that, showing all of this savings accumulated when it's just not true. So if you disagree with me, please let me know in the comments down below. If you find these velocity banking videos where they just make it seem so awesome and it's so so easy to just save all of this money, send them to me and we'll go through them together. I plan on doing a lot more about getting out of debt, velocity banking, just because it annoys me when I see these videos. You'd have to see the comments. There's so many people signing up for whatever she's selling, saying this is the greatest thing in the world. And again, it's not at all, all right? If it is getting you focused on paying off your debt and getting organized, then I'm all for it, all right? But don't replace low interest rate debt for high interest rate debt. Don't start taking equity out of your house to bang this out. It's just very, very risky. And interest rates are very high right now, so it's hard to play that game and to save money on the interest costs. Let me know your thoughts below. Thank you for being here. I will see you again in the next video. Thanks.